Fast food, cars, soap, hairspray. These are very different items we use every day. But behind these products are specifically manufactured chemicals, oils, plastics, surfactants, and one company to supply them all. This is DNL Industries, the largest specialty chemicals manufacturer in the Philippines and exporter to the Asia-Pacific region. DNL is the leading supplier of custom-made food ingredients, oleochemicals, plastics, and aerosols that are crucial in differentiating popular consumer products across various industries. With it deeply integrated in the value chain of consumption-driven economies like the Philippines, this company presents the perfect building blocks for sustainable growth. We, at Ateneo de Manila University, issue a buy recommendation. DNL has a market cap of $1.5 billion and a free float of 30%. Over the past year, the stock has outperformed the PSE index by 5%. From current levels, our DCF-based valuation has led to a target price of 13.30 pesos, a 15% upside. So why a buy on DNL? 1. DNL has a favorable industry position that fuels steady domestic gains. 2. It has an international growth strategy backed by R&D expertise. And 3. It has a strong ability to deliver long-run profitability.
So let's start with our first point. DNL's favorable industry position makes it a diversified play on domestic consumption growth. The Philippines has always been a strong consumer play, on the back of stable remittances, BPO revenues, and tourism receipts. But unlike other consumer names, what makes DNL unique is its strategic position at the back end of the value chain, where it is the market leader and faces little to no competition. This allows DNL to capture the strong growth of Philippine consumption by providing custom-made key inputs for consumer goods, giving DNL broad exposure to resilient expenditure categories which account for almost 70% of the consumer basket. Cementing the solid position is DNL's shift from commoditized to specialized products, tailor-fit to client needs. For DNL's clients, these products give rise to signature offerings growing faster than other menu items, allowing DNL to enjoy lower threat of substitutes and higher margins of 25%, similar to selling branded consumer goods. We expect these high-margin products to grow from 63% to 71% of sales, driving a gross margin expansion of 160 bips. Finally, DNL has developed long-standing relationships with large industry players who have strong brand equity and wide sales channels. This positions DNL as a supplier of choice for multinationals who are looking to localize their supply chain. So with its integral back-end position, shift to specialized products, and long-standing relationships, we expect DNL to deliver a steady 10% growth for its domestic sales.
Complementing DNL's domestic gains is its international growth strategy, in line with its long-term goal of growing its higher-margin export business to 50% of sales. DNL is expanding to a $260 billion Asia-Pacific specialty chemicals market, 20 times larger than that of the Philippines. So how exactly will DNL achieve this? DNL boasts a solid competitive edge in R&D, with an R&D to sales ratio double the average of regional manufacturers. DNL's R&D has supported the development of over 650 custom formulations, consistent with increasing industry demand for client-specific, specialized products. These formulations drive more than 70% of exports. R&D has also allowed them to secure key foreign partnerships. Case in point, global food giant Ventura chose to partner with DNL among its Asia-Pacific peers, proving DNL's ability to meet global standards. Through Ventura, DNL supplies custom ingredients to Burger King, Subway, and A&W in China, Hong Kong, and Indonesia, adding 5% to revenues in just 2 years. We expect this Ventura partnership to continue posting gains as coverage expands from 4 markets to the rest of the region. And supporting export growth is a new facility that will double DNL's capacity by 2021. So what does this mean for you as an investor? DNL's R&D expertise, with its strategic partnerships and capacity expansion, will allow them to grow their foreign accounts by their target of 5% each year and potentially attract other partners aiming to expand. And as their export footprint improves, DNL is set to capitalize on strong regional demand for specialty chemicals, expected to grow at a 7% CAGR. We expect DNL's steady domestic gains and its high-growth exports to drive an overall top-line growth of 11%.
On to our last point, we highlight DNL's ability to deliver long-run profitability. We expect DNL's increasing shift to specialized products for both domestic and export sales alongside continuous operational efficiency to underpin a net margin expansion of 100 bps, driving a robust EPS growth of 13%. Historically, DNL has shown a strong track record of maintaining profitability by pursuing organic growth while maximizing horizontal synergies. DNL has strategically diversified into related, profitable segments since starting as a specialty plastic supplier. This has continued to boost DNL's profitability as seen in its superior margins over 200 basis points above regional peers. Disciplined diversification has allowed DNL to take advantage of shared production, storage, and distribution. This ability to extract synergies while expanding into high-growth markets is best seen in DNL's improving ROA. Moving forward, we believe DNL's low net debt-to-equity ratio of 0.2 times and strong cash flow generation ability are supportive of profitable opportunities for long-term growth. With its improving margins, healthy gearing, and efficient turnover, we expect DNL to deliver an ROE expansion of 220 bps over the next 5 years, reflecting long-run profitability and strong shareholder returns.
In light of DNL's steady domestic gains, regional expansion strategy, and long-run profitability, we derived a one-year target price of 13.30 pesos, presenting 15% upside. We used a discounted cash flow model employing a 9% WACC and 3.5% terminal growth rate. Our WACC is based on a 6.5% risk-free rate, while our terminal growth rate is based on long-run inflation in the Philippines, long-run consumption growth in the Asia-Pacific region, and the growth of specialty chemicals in mature markets. We note that 73% of our fair value is driven by its resilient domestic base, with the balance from its high-growth exports platform. We also conducted a relative valuation to support our DCF, which likewise show attractive upside for the stock. We compared DNL to domestic consumer names due to the lack of direct comparables in the local chemicals sector and DNL's position as an indirect consumer play. For regional peers, we selected Asia-Pacific specialty chemicals manufacturers. At 22 times PE, DNL trades at a discount to both domestic and regional peers. We see that this is also below its historical average of 26 times. We believe our analysis revealed attractive valuations, given DNL's industry-leading ROE and unique industry position that drives resilient earnings growth.
Amid our favorable growth outlook, we recognize that DNL faces inherent business risks. Today, we'll focus on 3. First, DNL may face competition risk as it expands to new Asia-Pacific markets. But we believe that DNL can mitigate this with its increasing R&D spend to support specialized export products with higher switching costs. And to add to this, should DNL grow its foreign accounts at only half its target rate, our target price is 12.9 pesos. 12% upside, still a buy recommendation. Second, DNL faces the risk of adverse price fluctuations for coconut and palm oil, which account for 59% of cost of goods sold. But we are confident that DNL can hedge against this with its pass-through pricing, where it can readjust prices every 30 to 45 days. And DNL's continued shift towards specialized, high-margin products will allow it to grow gross profit even with unfavorable shifts in commodity prices. Last, DNL is exposed to forex risk as it imports 56% of its raw materials. To mitigate this, we expect DNL to leverage on its growing export segment as a natural hedge through its US dollar-denominated revenues. Just to double-check, our sensitivity analysis shows that a 5% depreciation of the peso will only reduce margins by less than 1%. All of DNL's growth strategies and risk mitigation efforts are implemented by competent and experienced management committed to delivering sustainable growth and practicing good corporate governance.
Let's recap the 3 points behind our buy recommendation. 1. DNL's favorable industry position that fuels steady domestic gains. 2. Its international growth strategy backed by R&D expertise. And 3. Its strong ability to deliver long-run profitability. So, with a target price of 13.30 pesos, presenting 15% upside, this is DNL Industries, the key ingredient to sustainable growth. Thank you for listening, and we are now ready for your questions.
I start first. I'm quite convinced about the company. I think it's a good company. But my question is why only 15% upside? Is it too little?
Okay, so for our valuation, we used a risk-free rate of 6.5%, coming from higher interest rates last year in the Philippines. However, there is a lot of downside risk for our interest rate with the 10-year bond yield currently at 6%. So if we do use the 6% risk-free rate, we will have an upside of around 30%.
Hi, I have a question about your cost of equity. It says here that you have assumption of 10.3% cost of equity. Why did you decide to reward investors in this company an equity yield of only 5%? Because your target price implies a PE of around 20 or 21 times.
So our implied PE based on our target price of 13.30 pesos has an implied forward PE of 25 times.
Right, so the equity yield is even lower at 4%, but your cost of equity is 10.3%. Why is that?
Sorry, could you please clarify your question?
Okay, so because your PE based on the target price, the PE is 25 times, so equity yield is 4%, and therefore it's much lower than the cost of equity that you used in order to compute your DCF.
Oh, okay. So we believe that there is a lot of potential upside for the company moving past just 1 year's earnings. We see that DNL is starting to ramp up its export segment, and a lot of the growth opportunities will lie in the next 2, 3, 4, 5 years. And this is what we want to set DNL as a company. It is not a one-year play, but rather it's a long-term growth strategy that is very resilient.
So can you talk about whether they face import competition threats in their domestic market? You've talked about their export opportunities, but do they have any protection from tariffs or elsewhere domestically?
All right, so in terms of importing their raw materials, which are mostly coconut and palm oil. Sorry, is that your question? I just want to clarify.
No, other specialty chemical companies exporting to the Philippines.
So we don't see that as a large threat for DNL's domestic position. First and foremost, because multinational companies see the Philippines as too small a market to penetrate. So if they were to sell their products here, they would not be specialized and custom fit, which is what the end industries are requiring nowadays. There is an industry shift to more specialized products. And DNL is it's the largest and the only integrated manufacturer that's able to do this in the Philippines at scale. So we believe that DNL's domestic position is cemented.
In addition to that, DNL enjoys certain tax incentives that incentivize its production of specialty chemicals for the Philippine market as well as for its export segment.
Just one follow-up, how long do they last? Do they run out at a particular point in time? The tax incentive?
Yes, okay, so the tax incentives last for around 2 to 3 years, but then they are also renewable. So in our assumptions, we only factored in their existing current tax incentives, and we cut it off at their most recent date. So there is further upside should they renew these tax incentives.
Capacity expansion leading to utilization of 60%, that sounds very large, and you projected a slight decline in ROE, but can you explain a little bit more why it would be such a small impact?
So to clarify your question, you're talking about the new plant and how it will impact EBITDA. Okay, so since the plant will be opening in 2021, we do see a slight contraction in operating margins. However, this is only minimal given that most of the operating costs are variable. So this comes with the opening of new production lines that will be custom fit based on demand. So as demand ramps up, that is when the operating expenses will start to kick in. So we believe that the impact to EBITDA will be minimal.
So I'm going to ask you to go back again into valuation. You've used a beta of 0.7, so which might be considered a bit too low for even the food industry. So have you done a sensitivity? That might be one reason why your cost of equity is low as well. So have you done a sensitivity on this? And how does that show?
Okay. So first, the way we calculated our beta is first we looked at comparables in the sector. So based on their unlevered beta of around 0.56 and applying DNL's quite under-leveraged capital structure, we did arrive at a 0.7 beta. In terms of, so we believe that this beta is warranted given that they're also in a very defensive position in terms of their industry. They're very resilient. Based on our sensitivities, if we look at our WACC sensitivities, we do have around 25 to 50 basis points additional before this recommendation turns into a SR.
You said that in the future the companies will increase its proportion of export to 50%. At that point, what kind of WACC would you apply? Would that change from the current WACC, considering that the risk-free rate here probably refers to just the Philippine market?
So we do understand that in the long term, we think that the company's operations will still mostly be based in the Philippines, so borrowings will still be pegged at local rates. However, we do understand that as it starts to expand, it may also take on more exposure in the global markets. However, the company is well hedged against this, and our sensitivity analysis do show that there is a lot of room.
You've got a chart in there showing the price-to-earnings ratio, and it's been pretty big swings between, say, 20 times on the low and 30 times on the high. Just what's driven that, and why is 25 the right valuation number?
All right, so if we look into our PE chart, we see a certain fluctuation. So as we look at the start, so that's because DNL, that is the point when DNL started shifting more towards its specialized products. So before, it started as a more commodity-based business. And then at the peak in 2014, we see announcements like the partnership with Ventura, which is the main lever for their exports growth. So we also see certain peaks and troughs. So like DNL had an earnings miss, just one quarter of an earnings miss in 2015 due to low commodity prices that were quite a shock. And so we see that it averages out to around 25 times. So we believe that DNL deserves to trade at this historical premium of 25 to 26 times, given that it has shown the strong fundamentals that back up this PE ratio, as well as comparing it to its other regional peers. So we see its closest peer trading at around 27 times. So we believe that DNL deserves to trade at these multiples.
So to add to that, we'd also like to clarify that it does deserve to trade at 25 times PE because DNL, being at the back end of the industry, faces little to no competition. So against its front-end peers, we are in that well-hedged position.
Yeah, but if I look at the chart, actually the mean of the PE is about 26 times, right? So you are expecting a very good growth company, more export, very bright future, but your expected target price is only back to the mean of the valuation, which is it can go up to 30 times. So my question is why you don't have a more aggressive or more high evaluate target price?
So to reiterate, we did use a risk-free rate of 6.5%. So if we were to use the risk-free rate of 6%, which is the current government bond yield, we're expecting around a 30% upside, which will be at PE levels of around 28 to 29.
What exactly does this company has in terms of international competition?
So in terms of international competition, there are a number of other specialty chemicals firms in the Asia Pacific. However, we'd like to highlight that DNL is broad-based in terms of in the segments that it participates in. So other manufacturers also create specialty chemicals that cater to other end industries like construction, pharmaceuticals, etc. So although there is competition, we believe that DNL is able to hinge on its capabilities for the segments that it does cater to. And we also believe that its strategic partnerships with Ventura and Bungi allow it to have sustainable earnings growth in the markets that they are participating in.
And And just the breakdown, what portion of the business do you think is commodity chemicals today? And did you think about factoring that into your multiples and doing a sum of the parts or a breakup rather than...
Okay, so currently the mix for commodities is the mix for commodities is around 30%. So 60, sorry.
With the buy on D&L Industries, that was Ateneo de Manila University. We'll now allow